Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to the calculation of book value per share. Get ready, because it's time to take a stance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that information into the blue area on our right-hand side into our worksheet. We want to calculate the book value per share. So the book value per share basically of the company. So what's the value of the company on a book basis and then the book basis per share. So when we consider that, we're typically thinking about where does the company stand at a point in time. In other words, what's the book value of the company? Can I give one number to kind of value the company? And then could I break that number down to a per share value per company? When you think about how something stands at a certain point in time, the valuation, which financial statement should we be looking at? We're going to be looking at the balance sheet. The balance sheet is where we stand at a point in time. Income statement represents performance, how we have done over a time frame, has a beginning and an end. Balance sheet, where we are as of now. So that's what we're going to look at. We're going to look at the balance sheet. We have some information to the left, kind of allowing us to basically reconstruct the balance sheet, right? We got the current assets, fixed assets, which should have a fixed here. And then the current liabilities, long-term liabilities, preferred stock outstanding, share of common stock. So we're going to assume here that these are all the balance sheet account, asset and liability accounts that we can use then to create the book value of the balance sheet. So if we consider the accounting equation, you can think of this in terms of the accounting equation, assets equal liabilities plus equity. The equity is where we stand. The equity section then is the book value, because remember, assets equal liabilities plus equity can also be rewritten algebraically as assets minus liabilities equals equity. So the assets minus liabilities equals what is owed by the owner, or the book value of the owner. That would be the book value. Therefore, the equity is the book value. Now, finance people often think of the accounting equation in this format, and you might think, well, why do we even use like this format? Why wouldn't this format be the standard? Why would we use this format, which doesn't seem like, this one almost seems more useful from a finance perspective. The reason this is the standard up top, assets equal liabilities plus equity, is because you can think of this equation as basically two sides of the same coin, right? These are two sides of the same coin. You got the assets, that's what the company has. The liabilities and equity represents who has claim to those assets. So of the assets, the third party people, liabilities, people that aren't the owners of the company, have a claim to some of the assets, and the other people are the equity, the owners have a claim. So that's why this first one makes sense and is very useful from a balancing type of standpoint. This one, when you're thinking about valuation of the company, as is typically the case with financing, is how we would think is very useful in that sense as well. So basically, we want to get to the equity section because equity represents, in essence, the book value of the company as of a point in time. So let's break this down. We're going to say, all right, what assets did they give us? Let's look at the assets that they gave us. They gave us current assets. And I'm going to bring this into the enter column. I'm going to say this is equal to the 230. We've got the fixed assets. I'm going to bring this into the enter column, which is the 173. I'm going to total this up. Total assets. In the outer column, I'm going to say equals. I'm going to use the sum function to do this. SUM, shift 9. I'm going to hit the left arrow once, up once, hold down shift, and then up again to select everything. I should close it up, but I don't need to. Notice you can also move this thing out of the way if it's like in your way, like it was right there. I could just hit enter. And so there we have that. Now let's format this just to practice some formatting, standard formatting here. Let's do some indentations. I got a colon, then I'm going to indent it. Home tab, alignment, indent. I'm going to indent this one again. Home tab, alignment, indent. I'm going to put an underline here. Home tab, font, underline. You might not think these things are important. In a small problem, they're not important, but they're useful to work with so that when you present this to somebody else, especially people that don't understand the financing or what you're doing as well, or even if you're talking to someone who does understand it, they're usually very, even if they don't really realize it, they're very tuned into how they've set up a worksheet. So you want to be able to set it up the way they want to see it, so that you can communicate whatever you want to communicate as easily as possible. So formatting really helps to do that. Once you're like big up in your firm, once you have your own firm or whatever, then you can format it however you want, and maybe it doesn't matter as much at that point, but can be impressive to put together the formatting. It's always a good thing to work on. So then we're going to take the liabilities then. Current liabilities, long-term liabilities. I'm not going to be breaking out current and long-term. I'm just putting the categories of, I'm trying to get to total liabilities and total assets. So I'm going to then pull these into the inner column. I'm just going to be saying, all right, we got the liabilities. This is going to be equal to the long-term liabilities. I'll sum that up in the outer column, hitting the equal sign, SUM, Shift 9, left arrow once, up arrow once, holding down Shift, up again, moving this thing out of the way so you can see what I'm doing. And then there it is. So sum of E7 to E8, E7 colon E8. You can close it up, but you don't need to if you only have the sum function, because it won't give you a little error sign. And you know when you go back into that it closed it up. We're then going to put an underline here, home tab font underline. And let's add the total. This is going to be total liabilities. Then let's do some indenting, selecting these items, home tab, alignment, indent. I'm going to indent this one again, home tab, alignment, indent. And then we can get to the equity. And I'm just going to call it equity down here, equity, which I'm gonna calculate just the total equity. Now they gave us some of the preferred stock outstanding and the common stock, but they didn't give us really enough information to give us the detail in equity. But I want to pick up the equity as simply the total equity of the 403 assets minus the liabilities, which is our second equation here. So I'm going to underline this, home tab, font, underline. So notice again, equity is kind of a generic name because it applies to any type of organization, right? If it's a partnership, it'd be partnerships equity. So if it's a corporation, like we're looking at most like time here, stockholders equity. If it's a sole proprietor, it would be simply owner's equity. But realize that as we, for example, for a corporation, we could break down equity. We've seen retained earnings, common stock, preferred stock within equity. But if you put equity together all as one, you can think of it as what is owed to basically the owners all as one. And then you have to break out who those owners are for the fact of a corporation. They're the stockholders. So you have to break out the equity per stockholder. And then for the fact of a partnership, it would be partners equity, capital accounts for the partners. But all of them are similar in that if you think of equity as a whole, it's simply assets minus liabilities equals equity, which would then be distributed to the owners, whoever those owners may be in whatever format those owners take, whatever form they have. So then we have, if we think about the bottom line, then we'd have liabilities and equity, which of course would be equal to this plus this, which is also going to equal the total assets. So that would be kind of your balance sheet balancing factor. This has to work because, of course, we subtracted these two out to get to the equity section here. So now we can get to our book value. So we know that this equity, that is basically the book value of the company. You know, if you were to sell the company, you'd start from that point. It's not going to be perfect, because there's going to be something including like fixed assets that might be not properly valued, right? Because they're on their at cost minus the depreciation that's an estimate. So you'd have to revalue the balance sheet to current value using appraisals and whatnot. But given what we know in terms of our financial data, this equity here on a book basis represents basically the value of the organization. So you'd think you can just take that equity and divide it then by the number of shares, because the shares represent ownership in the company or set units of ownership. One person can own multiple shares, but the shares represent a set unit of ownership. But we have that added feature that could be in the place, including the preferred stock outstanding here. So we got to deal with the fact that there's the preferred stock as one more step so that we can get to the common stock per share of common stock. Okay, so we're going to take the equity here. We're going to take the equity. We're going to be pulling out then the preferred stock because we have to pay them first. We don't really think of the preferred stock, even though they seem like preferred, like you would think they would. They're not really kind of thought of as the owners because they don't have the voting right typically. So we have to pay them first. So if you were to, you'd have to, if you were to liquidate this thing, you'd have to pay the preferred stock owners first or whatever to get to the common stock. So we'd have to say, all right, minus these preferred stock folk, which preferred stock might not be there all the time. It kind of muddies the water when they are for some of these calculations. And that's going to give us the net worth assigned to the common stock, subtracting these two out. So now we got the net worth to the common stock. Now we can divide by the number of shares to what we would think of as the owners, common stock owners, 25,000 shares. Now remember, that 25,000 doesn't mean there's 25,000 people that own the company. It means that there's 25,000 shares equal units of the company. Those shares could be being owned by multiple individuals, could own multiple shares. So we have to determine. So we're not really determining who owns this amount, right? We're determining per share, and then you'd have to figure out how many shares one individual has, and so on. So we're going to then divide this out. This equals to 144 divided by the 25,000. We have 6, and that's going to be something that we were going to want to add decimals to, most likely. So I'm going to go to the Home tab, Font group, bring out a couple decimals. That's 5.76. You can keep adding decimals. It looks like it rounds nicely to 5.76, but it doesn't have to. It could quite possibly, if you do a calculation like this, not be equaling an even number that goes out to dollars and pennies exactly. Okay, so there's going to be our calculation. So once again, this is assets minus liabilities is what you would think about. That would be the base worth of the company. If someone was to buy the company, you'd probably start off with a value in equity and then you would reappraise the value, right? That's kind of your starting point as what you would think of the value of the company. If you want to look at the value per share, you would divide that by the number of shares. However, you got to deal with the preferred stock that would typically be paid first. So pull out the amount to the preferred stock, and then you can divide by the number of shares outstanding. I'm going to put an underline here just to format this. Home tab, font, underline. We'll put a double underline under the 576. Home tab, font, drop down for the underline to the double underline, the 2 lines under the 576, that being our bottom line.